Welcome. You're watching the Mutual Fund Show. I'm Tamanna Inamdar. This is your one-stop destination for all things mutual funds and your investments. Now, the topic we're taking today is one which I think is the talk of the entire equity space, which is IPOs. There have been a whole host of IPOs coming in, more lined up in the future, and a lot of mutual fund investors are possibly even applying for IPOs in their individual capacity. But that's not what we're focusing on right now. We're talking about mutual funds and their growing participation in IPOs. How do you know if you are getting the best of the primary market through your mutual fund investment? In fact, do you have a better chance of getting a slice of the pie through a mutual fund rather than individually applying? Because think of it this way, with record SIP inflows, mutual funds also need more destinations for that money. And they have invested over 6,900 crores in 8 IPOs this August alone. Let me repeat that, 6,900 crore rupees in 8 IPOs this August alone, making it the largest primary market fundraising since May 2022. From major anchor investments in Brainbees Solutions, Ola Electric and Premier Energies. We'll explore what that means for investors and the mutual fund landscape. Of course, we don't have the figures for Bajaj Housing Finance, but that would be interesting to see as well. I'm speaking today with Aditya Nain, author, professor and creator, and Santosh Joseph, founder, Germinate Investor Services, for more on this. Welcome to both of you and great to have you on the show. Aditya, let me begin with you. And first of all, let's get back to the basics. Is it a good idea for mutual funds to look at primary issues and the primary market?
Tamanna, thanks for having me on the show. Firstly, I guess why not, right? Because look, if you're going to invest in an IPO, you'd rather do it through a mutual fund than as an individual, because I think they have a clear game plan as to why they're investing in the IPO. Are they investing in it for, quick listing gains, which would usually not be the case, or are they investing it for long-term capital appreciation? Which means they've done their due diligence, they've done their research on the stock. And as India's equity markets increase, retail participation does increase. Mutual funds, as you said, are going to look for various avenues to park that money, especially at a late stage of the bull market that we probably are in today. The market is flooded with IPOs because, this is the time of the market when IPOs do well. Lots of money flushing around, and so they need a home to find for themselves.
I'll tell you why I'm asking that question, Aditya. And yes, of course, why not is a fair enough answer, but I'm asking it from this point of view, and I'll take it to Santosh as well, that a lot of experts, financial advisors say that IPOs are not the best investment. Let the stock list, see how it's doing, come to a fair value, and then enter. That's when they're addressing individual investors. Won't the same stand for mutual funds?
Yeah, so I think with mutual funds, the added advantage that they have is their portfolio sizing is a lot more deliberate than retail investors. So, a fund is not going to put 50% or 30% of their assets in an IPO. They're going to put a small amount in any case, because look, IPOs are small cap companies at the end of the day because they're new. So a large, let's say, flexi cap is not going to have that much allocation to mid or small cap in any case. And from that mid or small cap allocation, they're not going to have that much to recently listed IPOs further. So I think that takes care of the issues. Of course, this also depends on the management style of the fund, right? Some management styles or managers are a lot more conservative. They'll take the Warren Buffett approach that let the stock find its price, which makes sense. As a reason, I don't invest personally in IPOs, but I feel a lot more comfortable if there's a management team that's actually taking the decision. And so I don't feel it's a no-no on the mutual fund side.
Santosh, let me come to you on that point. And before we get into, how to maximize your mutual fund investment if you want to tap the primary market as well, and we'll get to that in a bit. But at the core of it, because mutual funds have been very significant participants in the primary market as well. Sometimes those bets work, sometimes they don't. And at the end of the day, they're custodians of investors' money. Do you think that there's a bit of exuberance in the way mutual funds are also participating in primary issues? Santosh, that question's for you. Yeah.
I think the markets generally are exuberant right now. Now, whether we talk about IPO valuations being high or even the regular secondary market, the IPOs valuations being high, irrespective of the IPO pricing, I think for the mutual fund, the most important aspect is they have to consider the supply that's coming into the market for businesses, whether they are traditional businesses or new age businesses, whether the business is raising capital by offer for sale or they're raising capital because they want to grow the business or the promoter selling stake. The question of exuberance comes in is when you feel that everything is expensive, both the IPO and the non-IPO, and then you do not know where to deploy the money. But here there are also new age businesses that do not exist already come into play, and therefore in the month of August when you saw this data, both for IPOs and the monies that went into IPOs from mutual fund, there were also these new age businesses which we do not have essentially a great reference point for. They are businesses which are highly scalable, highly profitable, away from the regular businesses that are already available. So using the mutual fund vehicle for regular investors to participate in them is a great idea, and I don't think one can just look at it as exuberance. And I think we also have to understand that mutual funds participating in IPOs is better off for retail investors at least to choose which one to participate and which one not to. And I think another point that we can add is that a regular retail investor is better positioned through a mutual fund to get some allotment into the scheme, then they're trying their luck, because today winning an IPO allotment is more difficult than even winning the lottery.
Yeah, okay. So that may improve your chances, definitely. Now, let's look at it this way, Santosh. If you want to make the best of primary market, and a lot of exciting IPOs are lined up as well for the rest of the year, how can you maximize that through your mutual fund investments? Obviously, you'll apply for those issues if you wish to. All of that is on one side. I'm not talking about that. But in terms of mutual funds as a vehicle, how best to maximize it?
So mutual funds have actually been extremely efficient already in terms of maximizing on the opportunities as far as IPO participation by mutual funds, and therefore giving the end retail investor that exposure. Now, the quality of fund that you select, either thematic or sectoral or larger diversified funds, will actually depend on whether that scheme will even apply. Now, today, you have funds which you have even dedicated mandates to say, I will invest in the IPO markets either during IPO or immediately after IPO. Again, then when you look at a lot of small cap and mid cap funds, in fact, most of the IPOs that happen, you'll notice are small cap and mid cap funds. They have the ability to aggressively participate and sometimes even get the allotments done in the qualified segment part. So choosing a fund which you feel is most likely going to participate in IPOs is going to benefit the investors, going to benefit the scheme objective of what scheme wants to generate. The bottom line is we have to consider the IPOs that are there and the scheme that you're investing. If the mix goes well for in both the cases, then the investors benefited, and we believe that mutual funds will take a better decision than the retail investors themselves.
Okay, so that comes back to the question, and let me come. So which funds? Which funds? If someone's watching right now, Santosh, and they want to know how do I make the most of it, then give them something a little more specific. Which funds should they
Yeah, so
look at?
specifically, you already have Edelweiss now for almost 4 or 5 years running a fund earlier called the IPO Opportunities Fund, and now it's called the recently listed IPO Opportunities Fund. Otherwise, I think there is no specific fund that is available. You have to just play by the mid cap or the large cap or even the theme, because when you look at the month of August, you had a lot of funds which were in the new age and in the technology space. So therefore, a digital fund or a technology fund was more suited to take advantage in the month of August than any other traditional fund. So I think that's why you'll notice that most AMCs are now coming out with new age funds like digital fund or technology fund, because the entire universe of what we call tech and tech-oriented IPOs are increasing by the day.
Okay, I'll take that question to you, Aditya. Are mutual funds a good vehicle to maximize allocation, especially in big blockbuster IPOs? And like Santosh said, sometimes it's like winning a lottery. So you try and win that lottery, but you maximize your chances. How do you do it?
So I think the Edelweiss recently listed fund, and as far as I know, there's no competitor to that. I may be wrong. It would be your best bet. It could work well for like a core and satellite portfolio where someone has, let's say, index funds or flexi-cap funds as their core, but they want to play around a little bit with a small portion of their portfolio. They could try something like, the recently listed fund. However, I did take a look at the numbers earlier, and when you compare that performance, which is the fund essentially is about 50% mid, 50% small cap at this stage. When you compare the performance to, just any mid cap or small cap fund, even from the same fund house, it doesn't really give you that much of an advantage. So I would rather stay away from it. But if you really want to go for the IPO play, I think that's your best bet, apart from
Okay.
the technology funds.
Which technology funds? Or
There are
should
a
you,
couple of them.
yeah, should you choose depending on the IPO? So for example, if I'm an investor and I want to make sure that I have an allotment in say Swiggy, NSE, Hyundai, these are some of the big ones coming. How do you position yourself?
You don't have that much choice even in the digital or the technology thematic space. You do have, let's say, the Tata Digital Fund, the ICICI Technology Fund, and a couple of others more. I mean, and quite a few of them are coming up. You've had some NFOs in this space as well. I don't think you can say beforehand that, hey, I want to go with this fund to get the most advantage because, let's face it, the equity market is still growing. We're not in a space where we can say right now, this fund is going to invest in all the upcoming tech focused IPOs. So you may have fund managers taking discretionary decisions about which ones to skip over and which ones to go for, which is why, maybe we'll have more thematic IPO funds coming up, just like we have the Edelweiss one.
Okay, so there's an Edelweiss fund which caters to IPOs, but Aditya makes a good point. Comparative return doesn't show anything massive coming there. I suppose just wait and watch. Actively managed funds with a good history of astute fund managers is probably your best bet, because if there's an opportunity, they'll make sure that they are there. All right, let's get to your queries for the day, and the number on your screen if you want to write in to us. Remember, this is the part of the show where we get your questions and our experts answer them for you. Shirdi Nath writes in fast. He's 25, says he's been investing through SIPs for 3 months. The portfolio consists of 75% in equity and 25% in debt and gold. He's seen around 2% returns as of now. I suppose that's overall. Is it feasible to continue the SIP? Now, it's just for 3 months, so a little more patience perhaps expected. But Santosh, let me come to you first with that question. 2% return in 3 months.
No, I think we should not even think about the 2% or whatnot in terms of returns.
Yeah.
The good part for Shirdi Nath is SIP is going on. The asset allocation is fairly good between equity, considering the age of the person. It almost looks like, the 75-25 rule is being maintained between gold and fixed income as well as equities. Straightforward answer is please continue the good job that you've started off on. I think that 3 months should be well looked after 3 years or maybe 5 years or 10 years. And then you will realize that this returns of 2% won't matter. You may be sitting at far better returns than this. The success in an SIP is to stay as long as possible and maintain your asset allocation mix depending on your age and risk profile. But otherwise, nothing to debate or review this, just continue.
Okay. Nothing to debate and review, just continue. Aditya, would you agree? First of all, the 75-25 split makes sense to you?
Yes, it does. I'm not averse to that. But someone 25 years old, I'm usually biased towards an all equity portfolio. My motto for that age group would be just keep plowing as much equity in, especially if it's an SIP, because over the long term, that's probably going to outpace the other asset classes. But 75-25 is a good allocation. It's 2% up today. It could be 5% down tomorrow. Just turn off that app, check it maybe twice a month. And a couple of months is nothing. I know, I really feel for new SIP investors because they want to see quick returns. But the name of the game for you right now at age 25 is to accumulate as much as possible. So instead of stopping an SIP, you're thinking about changing it, just increase the amounts that you put in fact, whenever possible.
Okay. Rahul writes in to us, aged 20. Great to have So many people starting out with their SIPs and see so many young investors starting with their SIPs. That's just fantastic. Anyway, he has started with a Nifty 50 index fund, then shifted to a Nifty Next 50, and now I'm thinking about Nifty 500 Momentum 50 index fund, which is the best for a 40-year investment horizon. All right, interesting question there, Aditya. I'll let you tackle it first.
Wow, 40 years starting at age 20. That's great.
Just,
I wish I'd done
yeah,
that.
I mean, I'd really just a second for 3 cheers for Rahul, who has a 40-year
Yeah,
outlook at age 20.
that's amazing. I mean, something to be said for foresight. Okay, so if let me defer back to asset allocation a little bit. If you have a multi-fund portfolio, Rahul, and you're looking for a large cap allocation, I would go for a plain vanilla Nifty 50. If on the other hand you're looking for a all-in-one fund, then I'd go to something that involves the Nifty 500. I'd actually just prefer the Nifty 500 plain index fund. But if you're going for the momentum fund, that's fine. If it's a one fund portfolio, I'd go for the 500 momentum. Otherwise, I'd go for the Nifty 50.
Okay, so Nifty 50 is your choice. Santosh, what would be your advice?
I think I would say that we are actually spoiled for choice in terms of where you want to do an SIP. For long we believed that Nifty 50 was a great way of investing and forgetting about it, especially when you have a 40-year horizon. Nifty Next 50 made it even better by giving you a little bit of the mid cap exposure. But the cream right now is the Nifty 500. I agree with Aditya. The classic Nifty 500 itself is phenomenal, where about 75% is in large cap, the balance 25% is mid and small. Now, when you go to Nifty 50 momentum, the data that we have for the last 19 years is just too staggering. And if you can continue for 40 years, I am really, overjoyed for what Rahul may get, because the Nifty 50, Momentum 50 for in a Nifty 500 has delivered almost 1.5 times Nifty's performance. In fact, if I take the Nifty 500 Momentum 50 or the 19-year period of data that we have, against a 14-15% of Nifty's returns, this fund is giving you 24-25% of return by choosing the 50 momentum stocks. So the answer is very obvious that you would go with the Nifty 500 basket of 50 momentum stocks, and a 40-year time horizon will iron out any volatility, if ever there is any, in that 40-year period, and will make some really handsome gains over that period. So my verdict is Nifty 500 Momentum 50.
Nifty 500 Momentum 50. All right, you have both choices and a very long time horizon, Rahul. So, I mean, no harm in doing both. Saurabh is writing in, age 33, says, I am looking to invest 4,500 rupees a month. Can you suggest some funds? Now, no additional detail there on for how much or what the goal is or what the expectations are. But, okay, let's say that this is someone starting out with an SIP, has this amount to spare per month at 4,500 rupees. What would you advise, Santosh?
I think considering we have very limited data, and this happens, quite often, where people just want you to help them fix an SIP, I think they should begin with a balanced advantage fund. Today, traditionally, balanced advantages fund have a good mix of equity and fixed income. I think at 4,500, you shouldn't worry about too many schemes. You should worry too much about asset allocation. You take the 4,500, put it into a balanced advantage fund, and let it run for as long as possible. Should you do well financially and you have more lump sum money or SIP money, then you can spend some time to figure out an asset allocation and then choose between equity, flexi cap, multi cap, fixed income, whatever. But for now, keep life simple. Get this SIP run as long as you can. Choose a balanced advantage fund. Again, we are spoiled for choice, from funds that have just started recently to funds that have more than 10-year track record of performance history. Choose something that you're comfortable with and easy to start with, and go at it.
Okay. Aditya, let me come to you on answering that query.
Yeah, so I would actually agree, since we don't have much information, but if the investor does have a 5 to 7 year time horizon, then I would say, going back to either a Nifty 500 or a BSE 500 index fund or a multi-cap fund. Either of two would be great for me.
Okay, so keep it broad and keep it simple. Just even for a longer time horizon, Aditya, and we discussed this actually on yesterday's episode of the Mutual Fund Show, and an NSE 500 index fund, do you think is in that sense a safe bet if your play is on the Indian equity market?
I think so. Look, if you want a cross-section of the Indian market, I don't see how you can do much better than the BSE or NSE 500. I'm not one to say you should only go for active or only go for passive. I use both. I think people should use whatever they are comfortable with after doing their own research, of course. But if you're looking for an active fund, go for a multi-cap. That would be my go-to. If you're looking for an index or a passive fund, do the 500, the BSE or the NSE 500. I'm not a big fan of the Nifty 50 or the Sensex index funds because that's too, I mean, that's just large cap and it's not what I would want as a young investor for young investors. So I would want at least the 500 or let's say the large and mid cap 250, one of these two indexes if I was going passive.
Okay. Pavan is writing in, age 29, says they're concerned about recession. Should I continue an SIP, which is about 30,000 rupees a month, or pause for 1 to 3 months to invest in lump sum? Now, Pavan, it would have been great to actually talk to you and understand why you're concerned about a recession. What exactly is the nature of that concern? But coming to that, the question he has is, should I pause my SIP and invest in a lump sum down the road? What would you say to this, Aditya?
So I would say, Pawan, there are lots of things to worry about in life. I don't think pausing a SIP should be one of them. Don't think about recession fears. That's all part of the investment process. Recessions will come and go. If you have a long time horizon, you should hope that recessions come and go so that the market does, fall and you can get in and then the markets rise again. So don't try and predict the recession because, nobody can really do it very accurately. And the stock market movement does not correlate with recession movements. So stock markets are indicators, which means the stock market will move before a recession actually hits. So if you're looking at recession data, you've probably already missed an opportunity in the stock market. So for an SIP investor, I would say don't worry about recession data, just keep plowing more money in. If the market does fall, as I said earlier, just put more if you can.
So let me tweak that question a little bit with the assumption that our viewer is not necessarily talking about an economic recession, but a downturn in the markets. Because that is a query that we get very often. Aditya, I'm sure it's something that you feel very often as well. People are constantly wondering that markets at record highs, new highs, new highs. When is the turn going to come? And at that time, should I pause my SIPs so I'm not buying in at record highs and wait for markets to cool off? If that was the query, what would you say?
So if I were a new SIP investor and the market fell, I would be very happy. And this is something that I try to get new SIP investors to think about because you want to purchase your mutual fund units at lower prices rather than at higher prices. And if you're accumulating money in mutual funds right now, the lower price you get, the better it is for you. So no, please don't stop it because if the market does fall, because you have an SIP, you're automatically getting, your mutual fund units essentially at a discount, and that's a good thing.
Okay, Santosh, what would you say? And I'm going to present the modified question to you as well, because that's what most people are concerned about when it comes to their SIP, right? The economy is at one end, but the question is that, are you catching the falling knife of a falling market, or are you potentially in danger of doing so?
I think you're right, Amana. When they mean recession, they mean the market's going down and the depreciation in the value of the investments that they've made. Now, it's natural if you're a new investor to think that there are two things that can happen. Number one, either you pause or stop your SIP. And number two, you come back at the bottom of the market, hoping that you have actually beaten or taken the advantage of the market. Now, I wish this were true. And, many of us would be living different lives if that was possible to, predict a recession or predict a correction in the stock market and then come back again when it is done at a lower level, that is to sell high and then to buy low. We all know it's difficult, and Pawan, I hope you also get it that it's not possible to do so. Second, having a correction or a volatility or even a depreciation in the markets or correction in the market and your SIP continuing is the best thing that can happen to you, generate long-term value and wealth. Therefore, pause is completely out of the option. Please don't worry about the market going down or falling. Pause is not an option. You will realize that after few months or maybe 1 or 2 years have passed by, that this correction or this volatile patch has been your best investment experience because you're buying lower value, higher units, and making more sense of your systematic monthly investments over a period of time. So I think it's maybe in your best interest not to pause or stop. Yes, if you have a lump sum and the markets have corrected, make the most of it by adding on to your SIP. I mean, if that is what you're asking, let the SIP continue. If the markets have fallen 3 months, 6 months down the line, add some extra money if you have, but not to pause, but to continue as long as you can.
Okay. Mahima is writing in, age 30, says she's invested in Quant ELSS Tax Saver, ICICI Approved Tech and Bandhan ELSS Tax Saver Fund for 3 years. Should I continue investing in the same funds or switch? Aditya, you want to take this very quickly?
So, okay, so the ELSS funds, well, there's no need to switch an ELSS fund. In any case, you have a 3-year lock-in, so you may not be able to get out based on when you put it in. But just because, time has moved on doesn't mean you need to pick another fund. As long as your fund is highly rated, and you can check this on various websites for the star rating of the fund, as long as you've got, let's say, a 4 or 5-star rated fund, you're usually good. So I wouldn't recommend changing that.
Okay. All right, we have run out of time on the show, but thank you so much, Santosh and Aditya, for joining in, taking our queries. Thank you, viewers, for tuning in and writing to us. Numbers on your screen in case you want to reach out to us. That's all the time we have on the Mutual Fund Show, but stay tuned. A lot more coming up on the other side on NDTV Profit.